Welcome back. Now we're gonna go into we're working through Greek. So in this video, we're gonna be talking about gamma. So again, gamma right here, we're focusing on the 121 call for this example. So in the previous video, we did delta, which was 51 cents. Now we're gonna be doing gamma, which is 8 cents. So we're gonna go again into an example. So in this example again, we're looking at Apple. It's expiring March 19th. Again, remember they expire every Friday. So this one is expiring on that Friday of March 19th. The 121 call. So again, you're paying $2.14. Again, you multiply it by 100 because it's 100 shares. And so you're paying $214. So gamma, as you saw earlier, was 8 cents. So again, gamma is delta rate of change. So what that means is gamma is added on top of delta for every first dollar move. So after $1, you have delta. Then you have $2, $3, $4. You add gamma onto delta. So what that means is, say now, so Apple is trading at $121.03. So now let's say Apple goes up $2 and it is trading at $123.03. So now your contract will now be worth $273. And the way that works is delta, again, is 51 cents for that first dollar move, plus gamma, because it went up $2 now. So gamma, you add 8 cents on top of the 51 cents. So you have a 59-cent move or $59. So that's why your contract went from $214 to $273 because it went up by $59. So hopefully this is making a little bit of sense. I know it could be a little bit confusing, but if you just play around with it, you'll kind of see how delta and gamma work. They pretty much work really closely together. So in the next video, we're actually going to go over theta.